to the Power Market Report for Wednesday, January 27th. I'm Albert Liu. Hope you're doing well. Got a great show for you coming up, but I want to start with a quick market update. We are just a couple hours ahead of the Fed policy announcement, and stocks in the U.S. remain just a little bit up, mostly unchanged going into this meeting. But we finished up yesterday, about 1.5%, still down for the year though. The S&P down 7.5% at yesterday's close. In contrast, gold is up over 5% year to date. And it was interesting, last week, of course, we had a lot of news coming out of Davos. And one of the most interesting interviews I saw was a CNBC interview with Ray Dalio. They were on location interviewing a lot of these Wall Street titans. Ray Dalio spoke with the crew from Squawk Box, and it was very interesting.
So we're now in a situation globally where China plays an important role on the rest of the world, and the rest of the world plays a role on China, and that is negative.
So if I were to decipher this, though, you ended on negative. To fully put it in a sentence, you think we're in a bad shape here?
I think the risks are asymmetric on the downside. That's why I said before that I think the next major move in Fed policy will be toward a quantitative easing, not toward a tightening.
Do you think it will be effective? I mean, you point out that there's not a lot that we can do with monetary policy unless you get a quantitative easing.
I think it's going to be much more difficult this next time. And I think that it's pushing on a string. The term pushing on a string began in 1935. It's that challenge. That means that there's going to need to be fiscal policy with monetary policy. That's a risky set of circumstances because politically, fiscal policy is controversial. Do you tighten? Do you ease? So I think that's why talking about how the machine works is an important thing because that's apolitical.
But for an investor who's sitting here trying to take all of this in and say, okay, so now what do I do? What do I do about it? If it's so asymmetrically going the wrong direction, can you even be long equities? We had Scott Minerd out here before who said that he got flat at the beginning of this year.
Mm-hmm. I think that we don't talk about the positions that we have in the markets for obvious reasons. And I think you can't. I think you have choices. What are your asset classes? Is it going to be cash? Is it going to be equities? So for the most investors, I think it's important to have a balanced portfolio. That's why when we constructed this all-weather portfolio, it's a portfolio in which the assets are supposed to balance each other. The problem last year is that almost all assets in the world went down in value. That can't go on too long without producing a depression. So that means that the central banks have got to ease monetary policy and do the QE. I think that, the key for an investor is either you have to have an active investor who is going to be able to move quickly. And that's a challenge because they can't play that game. Right. You can't watch television and then make those trades well. And professional managers who have done well and have time are pretty much closed.
So you see Mr. Dalio there kind of pessimistic, saying that, look, we have all asset classes going down together. And incidentally, his hedge fund was the best performing hedge fund of last year. So he's not making excuses for poor performance, but he's saying that, look, we have correlation in asset classes. They're all going down. The average investor is kind of in trouble. And then he adds to that that this cannot go on long without triggering a depression. And so the natural conclusion from that is the Fed has to step in. And he's saying that the next move is going to be loosening, not tightening. And what was very interesting is when CNBC last week was teasing that interview or the replay of the clip, they were saying that Peter Schiff is sounding a lot like Ray Dalio. And that was the clip that they used or the enticement they used to tease the replay of that interview. And I thought that was really funny because no disrespect to Ray Dalio, but we all know Peter Schiff has been saying that there's going to be QE4 for a very long time. And Ray Dalio has come on relatively recently. That wasn't his first mention of it, but it's relatively recently that he's come on. And so this is kind of funny for CNBC. Of course, they could just have Peter Schiff on the show. He can make his own comments. But it's very difficult for them, for them to see Peter being right. Also, earlier in the week, I think it was last week, Futures Now had Peter back on, kind of gave him a victory lap, threw him a bone, I guess, for all the abuse he's been taking from them in prior months. Went out of the way to also mention how fair they are on that show. I thought that was pretty funny. Of course, if you are fair, you don't have to mention to your audience that you're fair, but they felt the need to do that. But yeah, my takeaway here is that not that Peter Schiff is sounding more like Ray Dalio. Peter Schiff is sounding like Peter Schiff. In fact, that is the criticism, and it's probably a fair criticism of Peter, is that he's been saying this for a long time, and until now, nothing has happened. But it is noteworthy that that Ray Dalio is mentioning this, and of course, I'm not surprised given his sort of bias toward or the all-weather portfolio strategy he has, which includes a lot of the assets that we like. So that's interesting. I don't know if we'll get QE4 this year, like Peter is saying, like Ray is suggesting, but I guess we'll have to see. I want to move on to talk about Apple, actually. Apple released earnings yesterday, and the stock is down. Basically, they're forecasting a sales decline. And this is the first time that they've done that in over a decade. Revenue for the first 3 months of this year are going to be 50 to 53 billion, which is below what people had expected and below prior reporting. And what's really, I guess, noteworthy about this announcement is that they're pointing the finger at China, Hong Kong in particular. And essentially that, they've been a big beneficiary of global expansion and global monetary policy, I think. And basically what they're saying now is that it's over, right? China is not expanding fast enough. And for all the people who said that China doesn't matter to the US, and if you watch US business news, you've probably heard this often and over again, that, look, China doesn't matter. But if you look at US stocks, the index versus the common man's experience, a lot of the stocks in the index are actually down. Many of them are in bear market territory already. And it's just the high flyers in these the weighted index that have been keeping the index. Even who was it? Nouriel Roubini, I think, from Davos made this point. That look, the index has been concealing the pain in the market, and Apple has been a big part of that. But now you see that it's turning around. So China absolutely does matter, as does the strong dollar. But I guess something that came to mind to me was that how big of a beneficiary Apple has been from all the stimulus. Now, they didn't receive direct stimulus, but if you think about it, you have a product in the iPhone that is incredibly popular and has incredible reach all around the world. People love this product. And just think of here at home in the US, how many forms of financing can be indirectly used to finance iPhone purchases, right? You have, for instance, anything that puts money in the consumer's wallet. So student loans, for example, you know that the young people love these devices. Student loans could be, I guess, seen as fungible, right? If you don't have to pay for college up front, some of that savings can be used for iPhones. Auto loans, right? If you can finance your automobile or lease it at something that's below market rate, and that money is available for discretionary spending like this. Also, home refinancing. Basically anything that puts more money in your pocket can be shoved into an iPhone. And I think that's what's been happening, and it's probably been happening around the world too. So the stock was down yesterday. It's down 10% year to date, and I think that's a bad sign when you see top line growth slowing or reversing. They've been playing, not just Apple, but companies in general have been using all sorts of financial engineering, right? Using this the cheap access to credit to bolster their earnings per share, stock buybacks and whatnot. They've taken that to the limit, I think. And now we're seeing some of the results. And we're going to have to keep watching that. Federal Reserve has been in a 2-day meeting, and that is going to adjourn, and the policy statement is going to be available at 2 p.m. Eastern. I'll take another trick out of Peter's bag and just say this is more open mouth operations. No one is expecting them to do anything, and I suspect almost all of the discussion they've had in the 2-day meeting is not what they're going to do, which everyone knows is nothing, but how they're going to do it. How are they going to phrase it? What language are they going to change? What does the market want to hear? I expect there'll be references to slowing growth. The Commerce Department on Friday is going to release their first estimate of fourth quarter GDP. And if you follow sort of the projections of economists, I like to read John Williams, growth is slowing. It's definitely slowing. And they're going to have to address that. It doesn't fit in with the narrative of everything is okay, just look at the employment numbers. So they're going to have to address that. And I highly suspect that they already know what this number is going to be, which is great for them because they can use it in their statement to further guide us the way they want us to go. There'll probably be some mention of slowing inflation and how that's a big problem. Of course, that's ridiculous that slow inflation will be a problem, but to them it's a useful tool because they can say, oh, we're very concerned about this slowing inflation, so we're going to keep watching that, and if it gets too bad, heaven forbid we actually have price reductions, then we'll be ready to stand in. And what this does is it keeps hope alive for the people who want more policy intervention. And just watching people, the way that they're acting, the interviews, it really seems like people are hoping for bad news because the bad news is always accompanied by more liquidity, which is really all that's keeping this market going. Okay, I want to turn our attention now to the water crisis that's been going on in Flint, Michigan. This story has been developing for some time. If you haven't been following it, it's just government screwing up again. That is pretty much the story. In 2014, actually you can go back further, basically Flint had a financial crisis and the governor took over. And they put Flint into receivership and his guys have been running the show. Well, what did they do in 2014 to save money? They changed their water supply from the Detroit system into another system, their backup system that draws water from the Flint River. This was done to save money. Well, hasn't gone so well because they didn't take the proper care, they didn't engage in the proper procedures and maintenance in terms of treating the water. Lead and other contaminants have been found in the water, and this led to a big crisis and a bit of a scandal actually, because this had been going on for a while before anyone in the administration, the state administration, recognized it. So you have tens of thousands of people without water now because the crisis has still not been addressed. The Michigan Attorney General has said that the Flint water is not even safe to bathe a newborn. So it's a very bad situation to be in. And here's a clip from Fox News.
The city of Flint, Michigan, still reeling from the contamination of its water supply of lead. Thousands of residents exposed to toxic levels of rust, iron, and the most dangerous of them all, as I mentioned, lead. The disaster putting Michigan Governor Rick Snyder in the political hot seat, with everybody from Democratic candidates to celebrities calling for him to resign, but the governor says he has no intention of calling it quits. And the governor joins us live right now from Ann Arbor. Good morning to you, Governor.
Good morning, Steve. It's good to be with you.
It's good to have you as well. For folks who are unfamiliar with this story, this all started when somebody decided, you know what, let's save money. Let's not get the water we always got it the old way. Let's get it someplace else. And what was in that water?
This begs the question, for the services that we consider most essential to our well-being, where do you put your trust, government or the market? Now, joining me now via Skype is Scott Rickards. He's the founder, president, CEO of Waterfund LLC has been a previous guest on this show. Welcome back, Scott. How are you?
Thanks, Albert. Doing well, and good to be with you again.
Thank you very much. What jumps out to you about this story in Flint? It's a crisis.
Yeah, the first thing that jumped out at me as someone who looks at the value of water and water tariffs is that Flint did something very unusual, which was they tried to dramatically decrease their cost of water supply by transferring their supply from the city of Detroit to the Flint River, which was of lesser quality. It was more. It was supposed to be less expensive, and it was mainly a budget move. So to me, that just shows where public finance is in Flint, first of all, and second of all, it just shows poor judgment to sacrifice water quality for I think what we saw was a 21% decrease in their raw water costs. So it's something that we live in a world where water is going up. The price of water, the value of water is going up, and Flint, in trying to reduce its cost, ended up in the situation they're in. So.
Yeah, and for me, this speaks volumes about the priorities of government. If you dig a little bit deeper, Scott, this is actually quite scandalous. So they had a financial crisis in Flint. They went into receivership. The governor put them in receivership, and they were calling the shots and are responsible for the change in the water supply. Now, what's come out since, I think just in the past month or so, is some emails. And basically, we've learned that Flint could have saved even more money by staying on Detroit Water because they were offering them sort of a different model contract and suggesting that they do things like switch their point of connection and provide their own backup services. And the combined result of all of that would have been they would have saved more money by staying on. So this was obviously a political process.
Yeah, good point. And you can never disentangle the politics when you're talking about water. So it seems to me that, and I think you're right about this, Albert, that it was more a political. There was some political resistance to being on Detroit Water versus a local supply. So that probably, I'm not that familiar with the local politics of Flint, Michigan, but it sounds like that was certainly a factor here. But the fact that they were in receivership in the first place, and the fact that it was, at least on the face of it, a budget move to change their raw water supply. That, as I said before, that flies in the face of what's going on in the broader market, which is, if you look at our index in Texas, or our index in California, what we call the water cost index, the raw water cost has been going up 70 to 80% in the past few years. So that's a big, it's hard when you have 100-year-old pipes to decrease your cost. At some point, these guys have to make some major capital investments, and that's where the pricing comes in. If you don't have strong water pricing, you're just not going to be able to make those capital investments.
Yeah, and too often they do that. They neglect what's important, but not, I guess, politically motivated, and in favor of their own, whatever their concerns are. And I don't know what the politics are there either, only know that they exist and are providing obviously very strong incentives. Scott, your office sent me down a couple of plots. I want to throw these on for the viewers to see. You basically referenced the water cost index for Texas, and we have that basically juxtaposed with the cost of WTI oil.
Well,
and there's a stark divergence there.
I guess anything would show a stark divergence with WTI crude at this point, Albert. So to be fair, I guess there are a lot of investments look favorable compared to oil right now. But one of the key investment points that we're trying to make with that juxtaposition there is that water's increase is actually a function of how low oil goes, because whether it's Texas or Saudi Arabia, the lower the oil price is, the more public deficits will increase. And one of the best ways to plug a budget deficit, if you're in government, is to raise the water price. And so that's what's going on in the States. It's what's going on in the Middle East, and a lot of places around the world that have relied on oil to fund their public expenditures. So it's a great time to be invested in water and to be investing in water for exactly that reason, because water is just one of those things that's undervalued. And when times are tough, as they are now in the public sector, there's only one direction for water to go. So that's part of what we're trying to show with that chart.
Okay, and you also have, it's a similar story in California, right?
Yeah, California, the numbers are still coming in. So the impact of California's drought, which looks like now it's somewhat over, actually, but the impact of the drought financially will be probably felt next year. In Texas, for example, was in drought until early 2014, and the financial impact was felt in 2015. So water operates with a bit of a lag, and that's why we saw the bigger jump in Texas versus California last year.
What explains the lag? Because I noticed on these plots you sent over that the last two data points, so 2014 and 2015, these are estimates. I assume, are they estimates that your firm has produced, or are they estimates from the government?
No, these are estimates based on all the financials, the preliminary annual reports, and so on that we receive from the water agencies. So our firm processes all these financials as they come in, and we try to keep everything as up to date as possible. And the reason there's a lag is because when a drought begins and a drought is being experienced, the financial reaction to that doesn't happen until 6 to 12 months later. And the reason is that that's how the public sector operates. If these were plants operated by GE, Siemens, or Veolia, you would see a much faster reaction time, and that's in fact the case when we see privately operated water plants around the world. But yeah, the public sector just takes a longer time to respond, and often doesn't have the financial resources to respond immediately either.
I suspected that was going to be the answer, Scott. We're getting fourth quarter GDP estimates, the first one on Friday for 2015, yet these guys don't have numbers for 2014 water yet. It's quite a large contrast there. And the other thing that jumps out at me is not necessarily water as an investment, but this juxtaposition is interesting because you see that you have oil, which is basically operating in let's not say an absolutely free market, but pretty free market. It's a global commodity. Water is also a global commodity, whereas you have it run essentially by the government. And what jumps out at me here is that in a free market, when a mistake is made, which obviously many mistakes have been made, the public doesn't suffer. In fact, in this case, the public benefits. Whereas in the publicly controlled utility, it always comes back to bite us. Like you said, they're going to be raising prices because of budget deficits.
Right. Yeah, listen, that is, as you said, one of the key differences between privately and publicly operated utilities. And so that's just something, that's just a fact of life in the water business. And the public, when you're talking about a municipal water supply,
Well, it looks like we've lost Scott for a second. Scott, are you there? Looks like he's dropped off. We're going to try and get him back. But this is what jumps out at me is, you see this divergence, and this oil price is obviously hurting a lot of people, but it's people who invested in oil and people who made loans into the sector. The case in water is completely different. Obviously, it's completely detached from the market, and we're going to end up paying more for water. Why? Because these governments can't manage their books. Still waiting on Scott here. looking forward to getting him back because I want to try to learn from him what kind of ways that investors can use to actually invest in water. Okay, we got Scott back, and let's continue our discussion. Scott, we were talking about public versus private, oil versus water. It's definitely a very dramatic case to discuss here. But you mentioned water as an investment, so I just want to kind of pick your brain on that. For people who want to look into this, water looks good relative to oil, but it looks good relative just to any benchmark you want to use, actually, if these projections turn out. So what ways do we have to invest in water?
Yeah, one of the things we've been doing, Albert, and thanks for the question, is looking to the industrial market for water around the world as a leading indicator for where water tariffs in the U.S. or Europe might be headed. The reason for that is the industrial market is priced more efficiently. As you mentioned, the private market is always going to price a resource or a commodity more efficiently. And so when we're in a bilateral contract, when we own water and we're in a bilateral negotiation with someone who wants to buy our water, that's a more efficient way to achieve pricing than having a board of managers in a city somewhere in the United States decide what the price of water should be. So we look to that as both where we should be invested, and we also look at it as a leading indicator for where the public prices might be headed. So, practically, what does that mean? How do you get invested in water? I'd say one, it's not easy to do, and that's because it's not easy to go out and buy a water plant. But that's something that my company, Waterfund, does. We go out and acquire water assets around the world, and we try to make those opportunities available wherever possible to a whole range of investors. So that's one way to do it. I would say, in terms of the public markets, water ETFs have been somewhat disappointing, but they are outperforming the market. So if you're just looking for a way to be invested in public equities and have sort of a play on water, there's the S&P Guggenheim ETF, which is okay. It's been performing certainly much better than the market. But that's not saying much. So I would say wherever possible, as an investor, you want to own you want to be in a position to own that water supply, whether it's water rights or an actual production facility, and that would be my advice. But easier said than done.
Yeah, how does the water ETF get its water exposure?
Through large caps. So I mentioned some companies like GE, Siemens, Veolia, which is the largest. They're actually involved in the incident in Flint. Veolia North America, which is operates, I think, 20 or 30 water plants in the United States. They had said 2 years ago that water quality in Flint, Michigan was of great concern. And no one listened to them, of course. But that's a company you can be invested in through the Guggenheim S&P ETF.
Interesting. Okay. And as far as those industrial contracts that you're talking about, what particularly do you watch? What uses of water is this?
So, right, large industrial companies need water for all sorts of things, whether you're in the, obviously in the beverage business or the food business, if you're in the petrochemicals business, mining, you name it, just about everything requires water. So what we try to do is, as I say, we achieve much more efficient and higher pricing when we can be in a one-on-one discussion with someone who wants to buy our water. So we always try to own and acquire facilities where we're in that position. And yeah, it's a whole range of different industries, and we tend to go out and buy assets in places where water is pretty scarce. So I was in Saudi Arabia and Qatar last week, and we were doing exactly that, acquiring plants in the desert, basically, to sell water to large industrial companies. So that similar opportunities exist in the U.S. Texas is a place that has been a very strong market for industrial water, and I'd say those are harder opportunities to get into, certainly at the retail level. But that's one of the things my company is working on, trying to make those as available as possible.
I don't expect you to have the answer to this, but it'd be kind of interesting to know what percentage of the costs water represents to, for instance, the beverage company.
Well, it's certainly very high. It's the largest expense, that's for sure. And I think it ranges between 40 and 70% depending on the company. But in Saudi Arabia, I can tell you it's about 75%. I think so, if I remember my figures correctly. So that's it's a big piece. Water is the most important input when you're doing just about anything in a desert. So.
Okay. Before we wrap it up, Scott, would you tell the viewers where they can learn more about these opportunities and you?
Sure. Our website is worldswaterfund.com, and there you can learn more about something we have called Blue Bonds, and everything about the company and the index can be found there as well.
All right. I want to thank you once again for joining me, Scott. I look forward to talking to you again the next time something like this comes up.
Very good. Thanks a lot, Albert. Thank you.
Thank you.
Bye.
And don't forget to visit powerandmarket.com for insightful interviews with the world's leading experts in economics, finance, and investing. Until next time, take care.